Imagine staring at a financial statement right in the middle of a high-pressure exam.
Oh, the worst feeling.
Right. You're looking at the numbers, trying to calculate a company's bottom line, and suddenly you realize that the very rules for how profit is presented, rules you thought were just, absolutely set in stone, have completely changed.
Yeah, they've been totally rewritten.
Exactly. I mean, your old textbooks are instantly obsolete, the techniques you've practiced for months were useless, and suddenly your own muscle memory is your worst enemy.
It's a complete structural shift from the ground up, really.
It is. The way global companies present their profit has just been fundamentally rewired, and if you don't know the new blueprint, well, you're flying blind.
You really are. The foundation you rely on to analyze performance has been completely dug up and entirely recast.
Welcome to the deep dive. Today we are covering the new standard, IFRS 18, and its impact on the FIA exams, specifically FA1, FA2, and FA5.
Huge impact on those papers.
Massive. So we will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
That way you can actually, apply this stuff today.
Exactly. So to set a solid baseline here, let's establish exactly what this new standard is. What is it, really?
Well, simply put, IFRS 18 is the new international rulebook. It was issued in April 2024, and it dictates exactly how an entity's financial statements must be presented and disclosed to the public.
Okay, so it's essentially like, well, it's like a global mandate reorganizing every single grocery store on Earth.
Oh, I like that analogy.
Yeah, like you can't just put the milk wherever you feel like it anymore. Under this new standard, every store must have the exact same aisle layout.
Right, so shoppers, or, investors in this case, can compare them effortlessly.
Exactly. You know exactly where the dairy is, and you know where the produce is, regardless of whether you're looking at a business based in Tokyo or Toronto.
That is a perfect way to visualize the mechanics of it. Because for decades, companies actually had a lot of leeway in how they arranged their metaphorical aisles.
They could kind of hide things, right?
Exactly. They could bury certain uncomfortable expenses down in the footnotes, or they could blend different types of revenues together. It made it incredibly difficult to compare one company's core day-to-day operations with another's.
Wow, so IFRS 18 basically steps in and takes that choice away.
It completely standardizes the floor plan.
But here's the trap, though, and this is a surprising fact for a lot of people listening. You might think, hey, I'm taking the FA1 exam, and the syllabus does not actually require me to prepare full financial statements myself.
So I can just skip over this thing.
Exactly. You think you can skip it, but you can't. Even at the foundational FA1 level, you still need to know IFRS 18.
Yeah, you really do.
You have to be able to identify the content and the structure perfectly. You might not be the architect building the grocery store, but you absolutely have to know the exact layout of those aisles.
Precisely. I mean, you need to be able to look at a statement of profit or loss and other comprehensive income and immediately recognize its anatomical structure.
Right.
Ultimately, what IFRS 18 does is create a mandatory, highly structured summary of income and expenses.
So we understand what it is now, the global standardization of the financial floor plan. But why does the examiner care so much? Like, why is this suddenly the hottest topic for the exams right now?
Well, if we connect this to the real business world first, investors have been crying out for comparability for years.
Because it was such a mess before.
Total mess. Let me give you a scenario. Imagine 2 companies that both manufacture and sell shoes. Right.
Okay, shoe companies.
Under the old rules, Company A makes a brilliant profit just by selling shoes. They're doing great.
Makes sense.
But Company B loses millions on their shoe sales because, well, their operations are just terrible.
Right. They're failing at their main job.
Exactly. But Company B happens to sell their massive headquarters building that year to cover the loss.
Oh, wow.
Yeah. And under the old flexible rules, both companies could potentially present a $5 million operating profit.
Wait, really? Even though one is failing?
Yes. One is a thriving business, and the other is a failing business selling off its furniture just to survive. But the old layout disguised the real story. Now, with IFRS 18, the exact source of income is mercilessly exposed.
That is wild. Okay, so
Yeah.
there are 2 reasons examiners love this. Here is the first. Examiners love testing these new, rigid categorization requirements.
Oh, they absolutely do.
They want to see if you can take a randomized list of a company's transactions and correctly slot them into the exact right buckets. They are testing your ability to follow the new rules of transparency, basically.
Yeah, they want to see if you can catch the company trying to hide the sale of its building, like in the shoe example.
Right.
They're testing whether you understand the strict, unforgiving boundaries of these new categories. And because the rules are so black and white now,
It makes for very precise exam questions.
exactly, there's no longer a gray area for candidates to hide in.
And here's the second reason examiners are just obsessed with this topic, the domino effect.
Oh, the domino effect is huge.
Right, because the issue of IFRS 18 didn't just happen in a vacuum. It created massive consequential amendments to other standards. Specifically, it directly altered IAS 7.
Right, which is the standard governing the statement of cash flows.
Exactly. So this is a critical point for anyone taking these exams. You aren't just learning one isolated new standard.
No, you're learning how this new rule book sends literal shockwaves through the older ones.
Yeah.
The actual mechanics of calculating a company's cash flows have been directly altered by the new definitions introduced in IFRS 18.
Examiners love a good domino effect. I mean, change one single accounting standard, and they suddenly get to test you on 3 different areas of the syllabus all at once.
It's highly efficient testing from their perspective.
Yeah.
It proves you understand the entire ecosystem of accounting rather than just, memorizing a list of disconnected rules.
Okay, so we really need to dissect the actual mechanics of this so you aren't caught off guard when you turn the page of your exam.
Let's do it.
There are 3 parts to this structural shift. Let's take them one at a time. Part 1, if I'm looking at this new standard, where do I even begin? How does it actually reorganize the numbers?
Well, it starts with the categories. Under IFRS 18, there are now 5 highly specific categories mandated for the statement of profit or loss.
Okay, 5 buckets. What are they?
They are the operating category, the investing category, the financing category, the income taxes category, and the discontinued operations category.
So every single dollar of income or expense must find a home in one of these 5.
Every single dollar.
But wait, simply put, if I'm a complex modern business with all sorts of weird one-off transactions, is there a default junk drawer where everything else goes if it doesn't fit neatly into, like, investing or financing?
That is a great question. The operating category actually acts as that default engine.
Oh, really? Operating is the default.
Yeah. Simply put, it comprises all income and expenses from a company's main operations. But crucially, if an item does not meet the strict definitions to fit into the other 4 specialized buckets.
It defaults into operating.
Exactly. It defaults right into the operating category. It represents the core everyday engine of the business.
Okay, that's part 1. Let's move to part 2. If every single transaction is forced into these 5 buckets, how does a CFO actually sum that up on the final page? Do the old total lines we used to use still work?
This is where the standard really gets its teeth. IFRS 18 introduces brand new mandatory subtotals that every single company must show on the face of the statement.
Mandatory subtotals, okay.
Yes, these are operating profit or loss before financing and income taxes, and finally, overall profit or loss. You have to show these exact stops along the way.
Wait a second. I'm looking at this list and gross profit isn't there. I don't see gross profit on the mandatory list, but that used to be the holy grail of a financial statement.
What's fascinating here is that you are completely correct to spot that. Gross profit and profit before income taxes, for that matter, are absolutely not mandatory subtotals under IFRS 18 anymore.
Why did they remove it? That seems totally counterintuitive.
Well, it comes back to that idea of global comparability. Think about a software as a service company versus a heavy machinery manufacturer.
Okay, very different businesses.
Right. They calculate their cost of goods sold in completely different ways. So mandating a gross profit line forced wildly different modern companies into a one-size-fits-all metric that didn't actually fit anyone very well.
Ah, I see. So it was just creating confusion.
Exactly. Now, entities can still present gross profit as an additional subtotal if it helps provide a useful summary for their specific industry. But the absolute mandatory globally enforced lines in the sand are operating profit, profit before financing and income taxes, and overall profit or loss.
That is a massive shift in how we've traditionally thought about evaluating a business. Okay, so that leads us to the third part. The domino effect we mentioned earlier. How does this break the cash flow statement?
Right. So because of those new mandatory subtotals we just discussed, the rules for the indirect method of cash flows under IAS 7 had to change.
Okay, how so?
When you are calculating net cash from operating activities using the indirect method, you must now use your operating profit as your starting point.
Oh, because you used to use profit before tax under the old rules.
Exactly. Not anymore. Now you start with operating profit.
And there are new rules for interest too, right?
Yes, incredibly strict rules. Previously, companies had choices about where to put interest cash flows. Now, interest received is only included in investing activities.
No exceptions.
No exceptions. And interest paid is only included in financing activities. The flexibility is entirely gone.
Wow. Okay, so to bring that all together, IFRS 18 forces companies to categorize every single dollar into strict buckets, creating new mandatory subtotals, which then completely change how we calculate our operating cash flows.
That is the perfect synthesis. The strict categorization drives the new subtotals, and those new subtotals drive the entirely new cash flow calculations. It is a completely integrated, logical loop.
But abstract rules like this are incredibly tough to lock into memory just by hearing them. So let's take everything we just talked about and look at how this breaks down inside a tangible, real-world example.
I think that's a great idea. Let's imagine a globally recognizable business.
But real quick, just a caveat before we build this scenario out.
Yes, good point. IFRS 18 does have modified, slightly different rules for entities that have a specified main business activity, like retail banks or massive insurance conglomerates.
Right.
But those specialized accounting requirements are not examinable in any of your FIA exams, so we will focus purely on a standard commercial entity.
Perfect. So let's say our standard commercial entity is a global company that sells clothes.
Okay, a clothing retailer. Selling clothes is their primary stated purpose. Therefore, all the revenues and expenses directly tied to that core mission, buying the raw textiles, paying the store staff, running the checkout systems, sit squarely in the operating category.
And that builds up to our first mandatory subtotal, operating profit.
Exactly.
But let's say this retailer also happens to own a massive empty warehouse on the edge of town, and they decide to rent it out to a logistics company for some extra cash on the side.
Right, which happens all the time. Under the old rules, a company might try to blend that rental income in. But under IFRS 18, that rental income does not get muddied with the retail clothing sales.
Where does it go?
It goes strictly into the investing category because it is income generated from an investment property. It is completely separate from the core operating engine of selling T-shirts and jeans.
Okay, and let's add one more layer. Let's say to fund a massive new expansion into Europe, this clothing company takes out a huge loan from a bank.
Then the interest expense they have to pay on that massive bank loan is isolated. It goes strictly into the financing category.
Because it's a cost of funding the business, not running the store.
Exactly. It's a cost of funding the business's capital structure, not a cost of running the daily retail operations.
You know, if you are a junior clerk, maybe you are 19 or 20, just starting your career, your daily reality changes with this standard.
Oh, big time.
The actual terminology you type into the accounting software is shifting. The exam reflects this exact reality. You might be staring at a multiple choice question and see the phrase payables for goods and services received instead of the old traditional trade payables.
Yeah, or you might see administrative expenses instead of general and administrative expenses.
Yeah.
The daily language of the profession is evolving to match the new standard.
Right.
And if we would look at this from the complete other end of the career spectrum, say for a chief financial officer analyzing this business, these changes are a revelation. Because the CFO is laser-focused on those new mandatory subtotals. They can look at the operating profit line and know with absolute mathematical certainty that it accurately isolates the retail performance.
Because it's uncontaminated by the warehouse rent.
Exactly. And it is completely untouched by the bank loan interest.
The noise has been separated from the signal, and that right there is exactly what the examiner is testing when they ask about the new presentation requirements, separating the noise from the core operations.
They want to see if you can act like that CFO, even on a foundational FA1 exam.
Which brings us to the trap. Because as beautiful and logical as this new system is, it is going to cause an immense amount of heartache in the exam room.
It really is. It's going to trip a lot of people up.
Let's talk about what students get wrong. The single most common mistake candidates are going to make this year is messing up the starting figure for the IAS 7 statement of cash flows when using the indirect method.
It is practically guaranteed to happen to thousands of students. The reason why this happens is purely neurological.
It's metacognition, right?
Yeah, exactly. Under the old rules, students and professionals alike spend hours, days, and weeks building the muscle memory to always start their cash flow statement with profit before tax.
Right.
Your brain literally built a thick neural pathway that says, indirect method equals start with profit before tax.
And under the intense stress of a timed, silent exam room,
Your brain defaults to the most deeply ingrained familiar pattern to save energy. It just runs on autopilot.
it's like someone's secretly remapped the hotkeys on your keyboard overnight. You know, your brain instinctively hits Control V to paste a document because you've done it 10,000 times, but suddenly that exact motion deletes the file.
That's exactly what it feels like. Your muscle memory is actively sabotaging you.
So here's the fix, and you need to do this right now. You have to mentally cross out that old rule. You need to actively hard code a new pathway.
Yes. The new anchor is operating profit.
When you see an indirect cash flow question, visualize a giant flashing neon sign that says operating profit. That is your new starting line.
You have to consciously and deliberately override the old programming. Because if you don't start with operating profit, your entire cash flow calculation will be fundamentally mathematically flawed from line one.
Wow.
You'll just waste 20 minutes calculating a number that is guaranteed to be wrong.
Muscle memory is great for riding a bike, but it is terrible for passing accounting syllabus updates.
It truly is. You have to be deeply intentional about unlearning the old rules.
All right, knowing what to avoid is half the battle. Let's give you your exact exam edge. Here's exactly what you need to do to score the marks and walk out of that exam room feeling confident. 3 things.
3 things.
Here's number 1. Be flexible with your terminology. The exams will use terms largely consistent with IFRS 18, but as we mentioned with the junior clerk example, do not panic if you see slight variations.
Right, if a question says profit for the year instead of just profit.
Exactly. Or if it uses administrative expenses, recognize that they mean the exact same structural thing. Do not let a slight word change derail your understanding of the 5 main categories.
And number 2, know exactly what isn't examinable. Your study time is precious, so do not waste a single minute reviewing things that will not be on the paper.
So what should they skip?
The discontinued operations category, which is defined by a different standard, IFRS 5, will not be examinable in any of the FIA exams.
Okay, good to know.
And as we mentioned earlier, the special accounting requirements for entities that invest in assets or provide financing as a main business activity like retail banks and insurers are completely off the table. Focus all your energy on standard commercial entities.
Perfect. And number 3, lock down the new interest rules for the IAS 7 consequential amendments. These are easy, guaranteed marks if you know the rule, and guaranteed loss marks if you don't.
Interest received is only investing.
Interest paid is only financing.
There are no exceptions for a standard commercial entity. Do not try to overthink it or cleverly justify putting it into operating.
So ultimately, if you take one thing away from this deep dive, remember that IFRS 18 is simply about stripping away ambiguity so that operating income, investing income, and financing costs are strictly separated into mandatory, globally comparable subtotals.
That is the entire philosophy of the standard in a single sentence.
You know, if you are just starting out your career in FA1, you actually have a massive advantage here.
You really do.
You don't have any old habits to unlearn. You are learning the language of global business exactly as it is spoken today. You don't have to rewire your brain. You are just wiring it correctly the very first time.
Absolutely. And for the seasoned professionals tuning in, this is your opportunity to demonstrate a cutting-edge understanding of global financial transparency. This isn't just about passing a syllabus update, it is about upgrading your fundamental financial literacy.
Yeah.
Master this, and your analysis is bulletproof. You will spot the reality in financial statements that others simply miss because they are still looking through the murky lens of the old rules.
We started this deep dive talking about the fear of staring at a financial statement where the rules have suddenly changed, where your textbooks feel completely obsolete. But now, that statement isn't a mystery at all.
It's not a trap designed to fail you anymore.
Right. It is a perfectly categorized, highly logical map of a company's reality. You know the exact layout of the aisles.
Exactly. When you sit down for the exam, just remember the 3 pillars we discussed: strict categories, mandatory subtotals, and a brand new starting point for your operating cash flows.
As you go back to your notes and start practicing these new rules, think about the algorithms for a second.
The algorithms.
Yeah. If IFRS 18 is actively forcing every single global company to perfectly categorize their data into strict, identical buckets, what happens when AI trading bots get a hold of this flawlessly clean, standardized data?
Oh, wow. The speed and accuracy of investment analysis is about to change forever.
Exactly. The standardized floor plan doesn't just help human investors, it trains the machines perfectly. Something to think about. We want to genuinely thank you, our global audience, for joining us on this deep dive.
It's been great.
If this helped clear the muddy waters of the new syllabus updates, please follow the show on Spotify and leave us a review. It really helps us keep making these guides for you. Thank you for listening.